In this video, I want to discuss what is a 7702 plan or a 7702 plan, and just kind of go over the pros and cons of it whenever somebody sets them up, how they may set it up incorrectly, and the importance of making sure that it's properly structured. So the 7702 plan is just a marketing name for a properly structured cash value life insurance plan or life insurance policy. There are benefits within the cash value component of a permanent life insurance policy that you could leverage for tax-free growth, tax-free income, and because it's under the house of life insurance, it will produce a tax-free death benefit upon your death. So it could give you these three mechanisms or even multiple other mechanisms of protection in there, making sure that you're able to place the monies aside. It's growing in an account. That account is growing based on either a market linked index or growing off of a type of fixed account known as a dividend rate from like a whole life insurance carrier, which sounds great, but there's a lot of problems with these sorts of plans. So, when you're reviewing this, take down notes. At any point in time that you have specific questions or you might be interested in this sort of strategy, feel free to give our 1-800 number a call. It's 1-800-566-1002. So what I have displayed up on the screen is a generic concept of the inner workings of a permanent life insurance plan. So simply put, money goes into the plan. The plan has a combination of cost of insurance and other expenses. Whatever is paid beyond that cost of insurance and other expenses drops down into a type of savings account known as a cash value bucket. What determines this cost of insurance and other expenses is the net amount at risk, the main risk being the death benefit to the insurance company. So you got to look at it from their perspective. If they go and they're insuring somebody for $500,000 and somebody made a premium payment of $1,000 into this plan, and that person makes one payment and they get hit by a bus, the insurance company is now off of their books. 500 grand has to get paid over to beneficiaries because this policy was set up and forced. So if you think of it conceptually from a risk return aspect, what is the largest risk to the insurance company? Is it in the first few years or is it in the later years? It's going to be in those first few years. So the years, 5 years, 10 years, 15 years, that's where you're going to have the most amount of cost of insurance and other expenses that are shoved within this plan to leverage the law of large numbers, meaning thousands, millions of other individuals that have policies that maybe they're now passing away. They've had it for multiple years. They're now passing away. So you have the new premiums, the new policyholders that are basically paying for their plan, and it's able to spread out that risk. So that's ultimately what an insurance company is doing. They're spreading out that risk. So one large factor of this risk is known as that net amount at risk, the NAR. So this is where whenever you're trying to structure a permanent life insurance plan primarily for a cash value play, meaning that you're trying to hoard the most amount of dollars in there, what are ways to make sure that this net amount at risk is as low as possible? The first tweak that they could make is reducing this death benefit. Because instead of a $500,000 death benefit, if let's say somebody created that same, they were putting away $1,000 into the plan, but they only have a $200,000 death benefit, is $200,000 less of a risk to the insurance company than a $500,000 death benefit? Yes. So because there's less risk, there's less cost of insurance and other expenses, and now you have more monies that are going into this sort of savings account, this sort of cash value component that's sitting in there. So what we're doing is we're focusing on the NAR, the net amount at risk. So where we come in a little bit differently in how it's known as a properly structured cash value plan is we look underneath the hood and we look at every little angle possible to reduce this net amount at risk further and further, meaning rather than just, simplify the death benefit or just reduce it a little bit, what is the absolute lowest that you could make your death benefit? Which carriers give you types of bonuses, types of persistency bonuses or credits whenever you're receiving growth within that cash value plan to make sure that any dollar that's being placed within this cash value side would be maximized from the actual contribution side and then also being maximized on the growth side from the rate of return aspect. So this is where we focus in primarily, well, the first step is definitely focusing on the net amount at risk, but then also cherry picking the correct carriers in a specific area, specific state, for an individual's age, for the time horizon that they're looking to place these monies in there for, to make sure that when they're setting up their cash value maximization strategy, it looks something closer to this. And maybe instead of the $200,000, the smallest amount of death benefit that somebody could place in there is $100,000. And this is where we get these questions. Well, why can't I just put $1,000 into a plan and just have a $1 death benefit? And you can't do that because, and this is where the 7702 or the 101A or these properly structured, IUL or whole life related plans, this is where that verbiage comes into play, is because it's focusing in on Internal Revenue Code 7702, Internal Revenue Code 101A, Internal Revenue Code 72E, these different aspects that say you have to at least have a minimal death benefit within legal limits. So as your cash value, you have something known as a cash value corridor. As your cash value is increasing, your death benefit has to be correlated to that increase. When your cash value starts going down, when you start removing monies from this, you want to make sure it's set up that your death benefit is going down with it. So what's the smallest amount of death benefit that the company will allow for, in this example, $1,000, whether it's $1,000 a month, $1,000 a year, whatever that case is, and that's where that's part of the process to make sure it's properly structured. So, this is more of just the specifics on how that works. If you think of it conceptually like a funnel, by reducing that NAR, that net amount at risk, any premium dollar you're placing into this plan is being set up in that type of bucket, that type of funnel. So that's the contributions that are going in there minus the expenses. This other side, this is what determines what sort of permanent policy it is. And this is the rate of return side. This is the percentage that comes back. So you could have a whole life, which is fixed like a dividend rate. You have a universal life, which is tied to interest rates. So this was very popular in the 1980s and has really fallen on its face since then because individuals expected interest rates to be so high. Now we have interest rates at all-time lows. So those are now known as blowing up plans of individuals minimally funded it, expecting a much higher rate of return than what actually occurred. You have mutual funds, which are set up with variable, or known as sub-accounts, which are set up as variable universal life, which are expensive and could have some downward market loss potential. And then you have IULs, which have been very popular in recent day, where it gains when the market goes up, gains 0% whenever the market goes down, based on those indexes that it's linked to. So you have some companies that have uncapped indexing strategies, some companies that have just very favorable cap limits with that. So you could have a favorable rate of return on this, but more importantly, you want to have a combination of the two. You want to have a combination of making sure the net amount of risk could be tweaked down as low as possible and the rate of return is as favorable as possible. So we understand the specifics on how conceptually that properly structured 7702 plan works, but once again, what's the whole purpose of this? It's to leverage an additional asset to what you're already doing for a retirement planning aspect, for a just an additional growth play or a savings type play or a college funding play. Really, it depends on what you're trying to accomplish, what your goal is, and whether or not this sort of cash value life insurance or 7702 plan that's properly structured can be beneficial to your situation or could it hurt your situation. So we understand the benefits with this is you could place monies aside that could grow tax-free within that cash value. You could pull income from that tax-free, and you could also leave a tax-free death benefit when it is properly set up. If it's not properly set up, then the growth within that account could be taxable. The income when you're pulling it out could be taxable above what your cost basis is. Also, dependent on how you set that up, there could be a portion of dollars of the death benefit that are taxable. So it's very important that you're at least making sure that you're taking those proper steps. If we look at the main concepts of financial planning, and somebody's trying to create a type of distribution strategy for retirement, they're trying to save monies now to create a distribution strategy for retirement, well, that will obviously be beneficial if they could have tax-free growth within their plan and then distribute money's tax-free income. Also, if taking monies from this properly and they hit their retirement age, where maybe their retirement monies or the retirement income is going to be a combination of pension income, investment income, and Social Security income, if they're taking monies from this 7702 plan, that could reduce the amount of taxation on Social Security income. If let's say you're able to supplement your income strategy from a 7702 plan, those currently are not incorporated in your provisional income that will increase the amount of Social Security tax. So that's a larger picture to think of it as well. If you're looking at it from a growth related play, you could have consistent growth within this sort of plan. Like if you're looking at it from a whole life perspective or an index universal life perspective, it could give you gains when the market goes up, not lose when the market goes down. You could have different bonuses every time that you're receiving those credits, you're receiving that interest gain into that account. So that could also take a portion of your assets and place it into a more of a conservative play, more of a consistent growth play, while your other monies are growing and they're ebbing and flowing more with your different diversification and allocations with investments. So this could be a nice little safe haven that will just add to further pieces of the puzzle. Also, based on your income situation, it could be a type of Roth IRA alternative. That if let's say you're not eligible for a Roth IRA because you make too much money and you known as phase out of that Roth IRA contribution limits, and you're not offered a Roth 401k through your employer, but you want to have tax-free growth and tax-free income and set these up properly, that's where individuals could place monies aside into these 7702 plans, and make sure that they're at least hedging a portion of their dollars towards that accumulation related strategy. So maybe they might have regular work 401k if they own their own business, and they're self-employed individual. Maybe they have a simple 401k or a SEP IRA where they could hoard a lot of dollars in there. Maybe they might have brokerage accounts and different non-qualified monies. Maybe they might have monies that are sitting in different IRA accounts, and they want to have some sort of tax-free portion, and they could go and help supplement contributions into a 7702 plan. That could work favorable when they hit their point B, when they hit their ideal retirement age, because now you could basically create proper distribution strategies at that point to make sure that these monies are flowing in at the most effective basis. Also, more recently, they started coming with ancillary benefits that are tied in there. What I mean by that is like long-term care related benefits or disability related waivers or terminal illness benefits. And this is where the insurance companies lets an individual, as they're still living, leverage a portion of their death benefit to pay for specific costs, whether that's costs of a nursing home, costs of a long-term care facility, assisted living facility, or a home health aid, or they want to pull out dollars because they're deemed terminally ill. There's different ways on how they could access, the death benefit. Or from a disability perspective, there's ways that how they could have their premiums paid for if they have certain disability waivers that are set up, within that plan. So there's a lot of, additional moving parts that you could add to this. Some of them have a cost, some of them don't have a cost associated with it. So it's definitely worth looking into. Like if you have two carriers, first place and second place, and one gives them the long-term care benefit for no cost, while the other carrier has a long-term care related cost with it. Well, that slight difference could be the reason why going with company ABC over XYZ makes more mathematical sense or more protection related sense. So this first portion obviously talks about all the great things about a 7702 plan, how to properly set it up. Now I want to shift gears and focus on the negatives of these sorts of plans. The first negative is a short time horizon. So what I mean by that is you could have an individual situation where they saw all this nice shiny object. They saw, oh, tax-free growth, tax-free income, tax-free death benefit. Everything looks great. But they were younger. They were looking to place their monies in there, and then they're trying to take their money out too quickly. So that shorter time horizon, what that's going to do is that net amount of risk and all those fees are front end loaded. So what this person's ultimately doing is they're paying for a very expensive product and they're not using this sort of plan properly. If you do not allow the monies within the cash value plan to grow with the power of compound interest by the consistent contributions that are going into this bucket and then the rate of return based on what sort of plan that you have. First of all, the contributions, we know that how we maximize that is by stripping away the most amount of costs. Well, the highest costs are going to be front end loaded, going to be those first few years. So if you're trying to already start pulling monies out before you're allowing it to fester in there, that's obviously going to be a large detriment. The other thing is the rate of return. some of these carriers, they give you additional bonuses after you've been in there for at least 10 years or 12 years or 15 years. So it makes more mathematical sense to leave it in there longer as a type of, persistency of saying, you know what, you're being loyal to us, so we're going to be loyal to you. We're going to incentivize you to keep your monies within this sort of account, or we're going to give you fee credits and try to really reduce those costs after 10 years, 12 years, 15 years into this sort of plan. So you could have a significant drop off in cost the longer and longer that you're in that sort of plan. And then when I unravel more specifically, how is a 7702 plan not properly structured? What are some key components to always look at? So this first little bullet point, the advisor, this is why many individuals call us up to set up their 7702 plans or their max funded IULs, max funded whole life plans, this properly structured cash value plans, is because we deal with them constantly. We're not just one of these, companies that we just got our life insurance license and we're just throwing a bunch of crap at one carrier that came to us that's saying, oh yeah, push our product, push our product. We're an independent agency, so we get to navigate through all the top carriers in that individual's area based on what their age is, based on what their time horizon is, and really educate them on whether or not it is a good strategy or whether that's going to be a large detriment for them. Try to paint that picture for them in the future. If they have any hesitancy towards, okay, I'm not going to be able to consistently place monies aside, or we don't know how to, properly set this up, or things are going to change very frequently, well then, with that lack of consistency, might mean not getting set up with that 7702 plan. So having that honest advisor to let them know whether or not it could be a fit for their situation. The other thing is the company. Each carrier is different. And out of, let's say there's 105, 110 different combinations of this sort of a permanent life insurance plan, there might only be two or three that are amazing for an individual situation, and over 100 of them that are horrible, meaning that they're very expensive. They have a very large cost of insurance. They have very low cap limits. Those fees are going to eat away at what the cash value growth is set up in there. So that's where some companies really value that sort of cash value maximization strategy, and they have these little sweet spots for that type of clientele, where other carriers might be really good from a life insurance side. They might be really good from a term life insurance or a permanent life insurance that somebody's trying to set up for just purely a death benefit play, not so much for that growth related play. So you got to be very careful with the type of company that you're using. Also the product. Like I mentioned before on the other PowerPoint slide, with the four main areas, you can either have a whole life insurance contract, a universal life, you could have a guaranteed universal life, you could have a variable universal life, you could have an index universal life, which one is going to be right for your situation. So that's where you want to understand the pros and cons of each and see exactly which one will layer properly for your time horizon and what you're trying to do. Index, if let's say you're going with this index universal life, does it make sense to go with an S&P 500 index or something that's a little bit fancier that will correlate better with this current volatile market environment? Something that will give you better uncap related indexing strategies for something that has very low caps related with that sort of account. So that index could correlate to whether or not you're going to have a favorable growth or not a favorable growth. Also with these indexing, is there ways to lock in that indexing growth mechanism versus other carriers that might not have that lock related feature? So those are some other variables or components to be mindful of. How it's designed. Just like how I mentioned in the very beginning, you want to make sure that you're focusing on net amount at risk, that we're leveraging the best carriers that will allow us to make those tweaks on the net amount at risk so that any dollar you're placing in there, is being leveraged efficiently towards that cash value play, towards that growth related play. Also, when it comes time to start pulling those monies out, could you only take it out in something known as a fixed loan rate option, or do you also have mechanisms that allow you to take it out in the form of an index loan rate option or a variable loan rate option? So that's going to be a large difference between the first place and the fifth place option, the first place and second place option. So that's why you want to be very careful with how it's designed. It has to be properly designed. Also funded, you want to make sure that you're placing those dollars in there, that you're having the minimal death benefit, that maybe you're trying to fund it for the first 5 years or 6 years, so you're getting rid of that cost of insurance, the net amount of risk, so that you're able to accentuate the amount of growth and jumpstart that growth as soon as possible. and then also using the policy correctly. And that really encompasses everything, is making sure that this is something that will be ideal for your situation. Somebody that's in their 30s could have an entirely different set of the top options than somebody that's in their 50s. Somebody in their 50s, it might not be favorable to leverage a 7702 plan, or somebody in their 60s because they're looking to take it out too quickly, and it really goes back to that short time horizon aspect. So I hope that all these different things make sense, because it's not just always rainbows and butterflies. There's a lot of pros and cons with these things. So you always want to make sure, okay, this is where I am right now. This is where I want to be with my ideal retirement date or savings related goal. How do I make sure that I go from point A to point B most effective, most efficient, and then from point B until date of death, if that's one of the main goals, is to make sure that you're taking out dollars from this until your date of death, or maybe more for short-term need. That really just depends on what that point B is to point C. Time strategy is something that I typically speak about regarding the acronym of time for an accumulation related strategy. We want to make sure it's most tax effective, most inflation related effective, or try to hedge against the pace of inflation. Want to make sure that they could have a reduction of downward market losses, and then most importantly is the expenses, something that will have the least amount of expenses. So TIME, taxes, inflation, market losses, and expenses, and this is where this will be a nice little piece for somebody trying to create those different aspects. We have a patented design, patented strategy known as the retirement diet plan, where it takes the key areas of financial planning and makes sure that an individual doesn't fall victim to common mistakes. So the D in diet stands for distribution strategy, the I stands for investment or growth related strategy, the E stands for estate/legacy, and then the T stands for tax planning. So making sure that all of these different things, if somebody's trying to create a proper financial plan, it's not just a portfolio. This is just a sliver. This example of a 7702 plan is just a sliver of what we do with our retirement diet plan process. If you are interested in having a further conversation, obviously feel free to give our 1-800 number a call. It's 1-800-566-1002. You can review our website, which is retiresharp.com or fossyfinancial.com. You can also set up a calendar appointment directly in there for a time that's most convenient for you. But at the end of the day, I hope that this helped bring further clarity to the situation. Feel free to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. And feel free to leave any comments, questions, whatever that is, so that I could help mold these videos a little bit better for you guys. But thank you very much. I hope you enjoyed, and look forward to speaking with you.